Hey everybody, I'm Logan Alec. I'm a CPA. I own Choice Tax Relief, and today I'm going to be walking you through Schedule A itemized deductions for inclusion on your personal tax return, Form 1040. Let's get right into it. So obviously, how itemized deductions work is you can deduct from your adjusted gross income. Like let's say you make $50,000 on a W-2 and that's your only income. So $50,000 your adjusted gross income. You can deduct to arrive at your taxable income, the actual income you'll be taxed on, either your itemized deductions or your standard deduction, right? So let's say you're single for 2025, tax year 2025, the standard deduction for single taxpayers who are not older and who are not blind is $15,000, right? So unless your itemized deductions exceed $15,000, you should take the standard deduction, probably in most cases, okay? We're going to walk through the itemized deductions here on Schedule A. I'm going to show you how to fill out this form. I'm going to talk through various tax rules pertaining to all these deductions here on the Schedule A, and maybe have a little fun while doing it. Okay, so let's get started. All right, so I already filled this part in, name and social. That should automatically populate from your tax software. Okay, the first kind of itemized deductions on the Schedule A are medical and dental expenses. Okay, now, but we're going to talk about what kind of medical and dental expenses you can include in a little bit. But first, I want to say that the medical and dental expense deduction, you're not going to be able to take all of them. Okay, you're only going to include as an itemized deduction the sum of your medical and dental expenses that exceed 7.5% of your adjusted gross income. Okay, so let's say you make $50,000. That's your adjusted gross income. Okay, what's 7.5% of $50,000? It's $3,750, right? So if you only had $3,000 in medical expenses, you can't. The math is going to work out. This is going to be zero. Okay, right? But let's say you had $5,000 in medical expenses and you had an AGI of 50,000, right? So let's say put 5,000 here. This is asking for your adjusted gross income right here. Right, 50,000 multiply 50,000 times 7.5%. That's 3,750. Right. Subtract line 3 from line 1. Subtract this from that. Right. That's 1,250. Right. So that's how much of if you had 5,000 medical expenses, that's how much you could deduct if your AGI is $50,000. All right, second key thing to know is what counts as qualifying medical and dental expenses. Okay, that's a great question. Now, there is an IRS publication 502, that goes in, covers a whole lot of stuff, right? I'm not going to go through all that. That would probably be worth a separate video. For now, let's just look at what the Schedule A instructions say about medical and dental expenses. Basically here, they give you some examples. And the point I want you to take away from this is it's relatively broad what counts as a medical or dental expense. There's some examples of what you can't include as well, but we're going to talk about what you can include. If you have a specific question, by the way, of what kind of medical, if such and such is a good medical expense you can count as a deduction, leave it in the comments. I'd love to research it and create a video about it. But here's just some examples of medical and dental expenses you can include in calculating your total medical expenses. Of course, to the extent you weren't reimbursed by insurance, right, or some other party, right? Insurance premiums, right? Makes sense. Prescription medicines or insulin, right? All kinds of physicians and specialists, right? And that even includes acupuncturists, chiropractors, right? Dentists, eye doc. You can see the list here, right? It's fairly broad. Medical examinations, X-ray and laboratory services, insulin treatments your doctor ordered, diagnostic tests such as a full body scan, a pregnancy test, or blood sugar kit, nursing help, okay. Hospital care, including meals and lodging, clinic costs and lab fees, qualified long-term care services, Medicare Part B, supplemental part of Medicare insurance, Medicare Part D premiums. So those, they get deducted out of your Social Security, right? Or you can get them deducted out of your Social Security. A program to stop smoking and for prescription medicines to alleviate nicotine withdrawal. Weight loss program as treatment for a specific disease, including obesity diagnosed by a doctor. Note, though, that this is different than just saying, oh, man, I ate too much over the holidays. I want to lose 10 pounds. And you just kind of just go on a diet of your own, on your own accord, right? Because I think it says that down here, right? Examples of medical and dental payments you can't include. The cost of diet food. Okay. Anyway, medical treatment at a center for drug or alcohol addiction, medical aid such as eyeglasses, contact lenses, hearing aids, etc. Guide dogs is in there. Surgery to improve defective vision. What is it? LASIK, right? That counts. Lodging expenses, but not meals, while away from home to receive medical care provided by a physician in a hospital. Right now, I think it says in here actually, yeah. Provided there was no significant element of personal pleasure, recreation, or vacation in the travel. Okay, so obviously, let's say you go to a doctor who happens to be in Hawaii, and you see the doctor one day, and then you're vacationing for the next 2 weeks. That's not what it's talking about here. Ambulance services and other travel costs to get medical care. Okay, if you use your own car, you can include what you spent for gas and oil to go to from the place to receive the care, or you can include 21 cents a mile, right? So it's kind of like, there's a mileage deduction for business, right? When you use your car for your business, there's a mileage deduction for when you drive to get medical care or to take your spouse to medical care, or your dependents to medical care, 21 cents a mile, okay? Cost of breast pumps and supplies that assist lactation, and then personal protective equipment, such as masks, hand sanitizer, and sanitizing wipes, for the primary purpose of preventing the spread of coronavirus. Okay, I think they obviously threw that in there in the past few years. All right, examples of payments you can't include. I'm down here. Cost of diet food, we talked about that. Cosmetic surgery, unless it was necessary to improve a deformity related to a congenital abnormality, an injury from an accident or trauma, or disfiguring disease. Okay, so they're making a distinction here between, let's say, a cosmetic surgery that is not improving a deformity caused by one of these things, and a cosmetic surgery that is. Let's use nose job, rhinoplasty, or whatever they call it. So let's just say you don't like the way your nose looks, right? Your nose is perfectly fine. It functions fine. It breathes for you. It gets mucus out. It does all the things a nose should do. You just don't like the way it looks, right? And you get the rhinoplasty on it, and you get cosmetic surgery on your nose. Can't deduct that, right? That's just because you wanted to get surgery on your nose, and that's it. That wouldn't count. Contrast that to, let's say you're in a disfiguring accident and your nose is now deformed. It's crushed, smushed, split. I don't know. I don't want to get too gory here. But your nose is now deformed, and that's related to an injury from an accident or trauma, right? You get cosmetic surgery to reconstruct your nose, that would be okay. That would count as a legitimate medical expense here. Life insurance or income protection policies don't count. I like how they put this in here. Medicare tax on your wages and tips, or the Medicare tax paid as part of self-employment tax. I'm sure people have tried to deduct that, and that's why that's in here. Nursing care for a healthy baby, illegal operations or drugs, imported drugs not approved by the FDA, non-prescription meds other than insulin, including nicotine gum and certain nicotine patches. Travel your doctor told you to take for rest or a change. This is funny, and the reason this is in here is I almost guarantee it's because somebody tried it. So, here's the example. Your doctor says, takes your vitals and everything, and your blood pressure, and man, you're stressed. You're not sleeping well. Your blood pressure is high. You should consider taking a vacation. Doctor just kind of says that off the cuff. Ding, ding, ding. Okay, I'm going to go take a 2-week trip to Hawaii or, somewhere else. Doctor's orders, right? That's not gonna fly. That's why that's in here, because I'm sure people have tried to deduct that trip under doctor's orders. All right, funeral, burial, or cremation costs. Okay, so this is not an exhaustive list. Okay, it is not an exhaustive list. It's just examples. Okay, I think we've beat up the medical and dental expenses enough. Taxes you paid. Okay, one big idea here is that it's ever since the Tax Cuts and Jobs Act, the Trump tax cuts, as they're called, that took effect in 2018, this has been limited to $10,000. This is called the SALT cap. Okay. Now that Trump is president again, there's a lot of talk about what's going to happen with this SALT cap. Are they going to keep it, or are they going to, repeal it? Okay. I personally think they're probably going to repeal it. And the reason is because a lot of the hot button districts for the House of Representatives are swing districts in blue states. I don't want to get too political with this, right? But for example, the district I live in, it's swung from Republican to Democrat to Republican to Democrat. Right. And it's generally these blue states that are most affected by the SALT cap because home prices and wages tend to be higher in these coastal blue states. So if I think if Republicans want to get brownie points with constituents in those swing districts in blue states, they would be wise to repeal the SALT cap. Okay. But let's not get too crazy about this. Now, basically, look. You can deduct up to $10,000 total, and this $10,000 doesn't change if you're single or married, right? Unfortunately, it isn't like, $10,000 if you're single, $20,000 if you're married. It's $10,000 for everybody, unless you're married filing separately, in which it's $5,000 each, unfortunately. But you basically just add up all the state and local taxes you pay during the year, okay? And it's income taxes or sales taxes. Okay, most people do income taxes because most people in certain states, well, at least where I live in California, most people pay more in income taxes than sales tax. Obviously, if you live in a state that has no or very low income tax, you're probably going to be using sales tax here. There is kind of a formula for the sales tax. If you don't track all the sales tax you pay during the year, your tax software should calculate that for you, right? So you'd put that here. Let's say that's $5,000, the income or sales tax. State and local real estate taxes, that's like property taxes. If you own a home, this is abysmally low, but just go with me here. Actually, let's make it high. Let's make it like 10,000. And then state and local, personal property taxes. This could be like, the DMV fees. Like in many states, when you get your vehicle registration renewal every year, there's a portion on it, and it'll usually say in the bill this much is tax deductible, usually fairly small. Let's say $500 for this. So if I were to add all these up, this would be $15,500. And then look, enter the smaller of line 5D or 10,000, right? So it's probably 10,000. Okay. Other taxes. So this would be typically, most commonly, what we would put there is foreign taxes paid to a foreign government. But it's usually more beneficial to take the foreign tax credit for those foreign taxes, not the foreign tax deduction here. Okay, because you can't double dip. You can only take one or the other, right? You can either take the deduction for foreign taxes or take a foreign tax credit. Okay, we're gonna assume this is zero so the total total taxes paid, itemized deduction $10,000. Okay, interest you paid. Obviously, now this is not all interest. Yes, you should be able to deduct credit card interest in the 80s, no more. Okay. This is pretty much just home mortgage interest on line 8 and investment interest on line 9. Okay. You're going to get if you have a mortgage, you're going to get a Form 1098 from the mortgage company. And it's basically going to tell you what the information you need to put on this form. Okay. So I'm just going to say, let's say you paid $15,000 on mortgage interest, okay, during the year. If you paid points, it would tell you that here. It'd be included in this line. All right, so let's just, but for most folks, it's just whatever the mortgage interest is in. I think it's box 1 of the 1098. That's what you're gonna put. Then there's also investment interest. Now, the investment interest deduction is interesting because it's limited to your net investment income for the year. Okay. and you calculate the amount you can deduct this year in Form 4952. Okay. And any amount you can't take this year because your investment interest exceeds your investment income gets carried forward to the next year. Okay. It's like an investment interest expense carry forward. If you change tax preparers or you change tax softwares, make sure you input your investment interest carry forward from the previous year, or else your new tax software or your new tax preparer is not going to know about it. Okay. Same thing with other carry forwards like capital loss, passive activity, all that good stuff. Okay. So what's the most common form of investment interest? Margin interest, right? You have your brokerage statement. Usually in the back, it'll say like, fees charged or something. Your margin interest would be something you would put there. Okay. Of course, limited to your investment income for the year. We're going to assume this person had none of that and $15,000. Okay. Just for the mortgage interest. Gifts to charity. This does not include personal gifts. Okay. You give your friend some money, you give your child some money, does not count. Okay. It has to be gifts to official charitable organizations that the IRS has given a stamp of approval to, saying these organizations, contributions to them are tax deductible. The IRS actually has a tool online that you can use to search for tax exempt organizations. You can click right here. And it's probably easier to search by name because you probably don't know the EIN. But let's save the koalas. Let's see if there's a save the koalas. Okay, how about save the whales? There you go. Save the Whales Inc. Right? So if you are, you want to confirm, you learn about Save the Whales Inc. You learn this is the EIN. They're in Salinas, and you're like, hey, yes, this is a legit. It's an organization eligible to receive tax deductible contributions, right? So that's how you can find out that a charitable organization that you're giving money to is to confirm that deductions or contributions made to that organization are tax deductible on Schedule A. Cash gifts are pretty easy. Now, if you gave a non-cash gift other than by cash or check, and if the gift you're claiming is over $500, you got to attach Form 8283. Not going to get into that here, but in a nutshell, there's more information you have to provide about large gifts, not large non-cash gifts, right? Because that can be abused, right? Because you're kind of telling the IRS what the value was. See what I'm saying? Oh yeah, I gave a very nice record collection to Goodwill or Salvation Army. It's worth $3,000. So the IRS has you fill out this form to kind of give further information, right, about the donated property and who you gave it to. Donated property of $5,000 or less, right? So if it's $5,000 or less, you fill out this section here, right? If it's over $5,000, okay, there's even more hoops you have to jump through, right? And in fact, you generally need a qualified appraisal for items reportable in this section B here. Okay, I'm assuming most of you aren't donating, a lot of fine art or anything, or So let's just go back to Schedule A here. Most folks, they're just given cash gifts, right? Let's say $2,000, to various charitable organizations, maybe their church, some charities, something like that. So let's just put $2,000. Casualty and theft losses. So used to be you could deduct almost all casualty and theft losses, but now they're only casualty and theft losses from a federally declared disaster. Okay. Ponzi scheme type losses are another kind of loss that can be deducted, still deducted as a casualty and theft loss, but it's pretty narrow now. The definition of casualty and theft loss won't apply to most folks, unfortunately. All right, now we have other itemized deductions. They're just lists in the instructions of specific deductions that can be listed here. Let's go on over to the instructions here. The biggest one that we see is the gambling losses, okay? But only to the extent of gambling winnings, okay? I've covered this in other videos. Link at the top of the screen to my video urging if you have gambling winnings, please report them on your tax return. So, let's say that you go to a casino and you spend $2,000 on gambling, and you win $1,000. Okay, that $1,000 is going to be reported on a W-2G that gets issued to you, and you're going to report it on Schedule 1 here, line 8B, at least for 2024 tax returns, right? Or $1,000 of the gambling income you won, your winnings. And that's going to be included in your adjusted gross income, and you're going to be taxed on it. Now, what about the $2,000 that you spent at the casino, right? Well, you can only deduct up to your gambling losses only to the extent of the gambling winnings. Okay, so you're only going to be able to report. So you're only going to be able to put $1,000 here. See what I'm saying? Right. Okay. And here's like the Ponzi scheme: casualty and theft loss of income producing property. So that's another thing you would put here. Ponzi scheme loss. Let's say that was even bigger. Let's say that was like 50,000 or something, right? Federal state tax on income in respect of a decedent, right? And these are pretty rare, I'm thinking, for a lot of you folks out there. So let's go back here. Okay, so let's say you have gambling loss of 1,000 and Ponzi scheme loss, so 51,000 here, right? Maybe I'm not going to include this. This probably isn't applicable to most of you out there. So let's just say 1,000 gambling losses. So then you add all these up, right? We got 1,250 plus 10,000. That's 12,050. 15 is 27,050. 29,000. So we got like $30,050 of itemized deductions. Sorry, my math was wrong. $29,050. Right? There you go. This is a lot, right? Now, if you're, let's pull up the standard deductions. This is a silly looking webpage, but okay, right. If you're single, this is for 2024. For 2025, there's a little more. For example, for 2025, the standard deduction for single is 15,000. But in 2024 tax year, the standard deduction for single is 14,600. Married filing jointly is 29,200. Right. So actually, if you're married filing jointly, even with all these itemized deductions, you're still going to be better off using the standard deduction, 29,200, because that is $150 more than your itemized deductions, right? So yeah, and another thing that the Trump tax cuts did is it made the standard deductions super, super high, right? So a lot fewer taxpayers itemize now. We're going to see if that continues, right? Because that increased standard deductions are set to expire with a lot of other provisions of the Tax Cuts and Jobs Act at the end of 2025. Is now that, Trump's in office, Republicans control the House and the Senate. I personally think a lot of those elements of the Tax Cuts and Jobs Act, including these heightened standard deduction amounts, will be extended. Okay, I believe they will be extended. So, but just to kind of round this out here, let's just so we can have, let's just say you're single, right? So let's just say you're single. So you're going to take this 29,050 amount, and it's going to go right down here, 29,050. Okay. Let's just work through the return here and just kind of show you how this all works, right? Let's say you made $40,000 as a W-2 employee, right? Okay. Blah, blah, blah. Right. Total income and let's say no other income, 40,000. Your AGI is 40,000, right? So you get your itemized deductions here. And this is assuming, you're single, right? If you're married filing jointly, you would take the standard deduction of 29,200. But let's say you're single with 29,050 itemized deductions. That's quite large for a $40,000 income, but let's roll with it. Okay, so this is 2950 as well. And then you subtract this from this. And what is that? Don't tell me. Is it the 10,950? Hope so. Okay. So instead of being taxed on your $40,000, your wages, you're only going to be taxed on $10,950. That's awesome. Okay. And then how do we calculate the tax on that? Well, here are the tax brackets for 2024. Remember, our taxable income is $10,950. So let's look at the tax brackets. Oh, look, for single filers, up to $11,600 of taxable income is taxed at 10%, right? You don't even break into the 12% bracket, right? So it's just 10%. So it's just, this times 10%, it's $1,095, right? And, you might have some credits and stuff that I'm not going to get into in this video because I really just want to focus on itemized deductions. But that's basically how itemized deductions and standard deduction, for that matter, kind of help you out, right, with your taxes. So, folks, do you have any questions about Schedule A, about itemized deductions? If so, please let me know. I have some other tax walkthrough videos here on the left-hand side of the screen that may interest you. I also have my TurboTax walkthrough video here at the upper right-hand corner of the screen. If you use TurboTax, that may be of interest to you as well. Thank you so much for watching, everybody, and I'll see you in the next video. Bye-bye.